Hello, I'm Hickey from interest.co.nz and welcome to a special report from here at the Reserve Bank in Wellington, brought to you in association with Bank of New Zealand, where we report on the half-yearly Financial Stability Report from the Reserve Bank. Now, normally this looks at the health of the banking system and the economy from a prudential point of view, and that's what the Reserve Bank did today. But also it took the opportunity to comment on the relatively high New Zealand dollar and a slight rise in market interest rates in the last couple of weeks. Reserve Bank Governor Alan Bollard said the rise in the New Zealand dollar, particularly on a trade-weighted index basis, had been unhelpful in recent weeks. He also said that the US Federal Reserve's moves to quantitatively ease, or QE2 as it's known, has been unhelpful in the plans for various developed economies to restructure their economies, to export more, to reduce their surpluses. Also, the Reserve Bank Governor said the financial markets may have put too much emphasis on a relatively strong employment figure last week in pushing up the New Zealand dollar and also pushing up longer-term wholesale interest rates. He said that this was more than the Reserve Bank was expecting. Now, that triggered a reaction on currency markets. The New Zealand dollar dropped from over 78 cents to under 78 cents on the comments from the Reserve Bank, which were widely seen as trying to cool down expectations of a faster and higher move in the official cash rate next year. Remembering, of course, that economists are expecting the Reserve Bank to leave it on hold until March next year. The Reserve Bank didn't comment directly on the official cash rate, but it did say that the markets seem to have overcooked the relative strength of the economic data in the last couple of weeks. Meanwhile, on the economic front and the financial front, the Reserve Bank said that many households and businesses, not just in New Zealand but in the developed world, were deleveraging, looking to repair their balance sheets, essentially save more and spend less. This would make the economic recovery tougher and less strong than some had expected in the past. Also, the Reserve Bank commented that in New Zealand, property prices seem to be falling again, and with lower land prices, that created a risk for some of the banks in terms of the quality of some of their loans. However, it also pointed out that the banks had reduced their vulnerability to a funding freeze. We all recall back in October 2008, when the global financial crisis meant that our banks and many other banks around the world were unable to roll over successfully their short-term wholesale market funding. And the Reserve Bank has been pushing those banks to move on to longer-term and more stable funding. It said the banks had increased their core funding ratio to over 70%, which was above the 65% the Reserve Bank was looking for. And the Reserve Bank remains on track to keep lifting that core funding ratio to 70% next year and 75% the following year. So there we have it, a special report from here at the Reserve Bank in Wellington, brought to you in association with Bank of New Zealand.